Post-tax season strategies. I'm going to kind of divert course from the PowerPoint here because there's a few I want to talk to you about, specifically some high net worth strategies. But Roth essentially means tax-free. A Roth IRA is a tax-free IRA. It grows tax-free, it distributes tax-free, and it passes on to your heirs tax-free. So that could be very, very important. There's penalties involved, early withdrawal penalties if you're not 59 and a half or older. Catch-up contributions to Roth. If you're still working and you're contributing to a Roth account, the limit is $7,000 per person. If you're over the age of 50, that goes up to $8,000 per person. Is what you can put into a Roth IRA. If you have a company-sponsored plan, a 401k, 403b, anything like that, and you have a Roth portion of a 401k, 403b, the contribution limit is much, much higher. I think it's also on that sheet I keep referring to, but it's about $23,000 is the maximum any employee can put into their employer plan in any given year. That limit goes up to $30,000, $32,000, something like that. It depends on our age, if we're 50, if we're 60, if we're 61, something like that. But the employer plan, you could put a lot more in Roth than you could with an IRA. And 529 plans, kind of new. That new legislation that came out. If you have old 529 plans out there, those are college saving plans for children. Those can actually be converted to a Roth IRA for the beneficiary, for the kid, not for the owner of the account. Over time, there's a few little nuances with that that I'll touch on. RMDs, required minimum distributions. When you turn 73 years old, all the traditional IRA money or the 401k money, 403b money, all the things we just said, if it's still pre-tax and it's not Roth, the government is going to mandate that you take out a piece of that. Whether that's, I think the starting first year RMDs is like 4%. You got to distribute 4% of the account because the government graciously let you grow that money tax deferred for all those years, and now they want you to pay taxes on it, right? So they're mandating that you take that out. And there's penalties if you don't, and they're pretty hefty penalties. It's anything from 25 to 50% if you don't take your RMDs out in any given year. So always got to make sure that we do that. One of the ways we get out of doing that, if we're not 73 yet, we kind of take your, there's no RMD requirement on a Roth IRA. So we'll take your IRA and we can convert it to a Roth IRA. Sometimes that's a taxable event. That can cost us tax dollars sometimes. So we want to be careful on how we do that. We don't want to bump you into the next tax bracket or anything. But that's kind of where our planning comes in, right? We want to make sure that your assets pass to your heirs as efficiently as possible.